Do you want to know what order blocks are? Whether you're a seasoned trader looking for new information or a beginner eager to learn more about order blocks, this video is for you. We'll be covering everything around order blocks. Our mission is to help you, so let us roll the intro and get right into it. Greetings traders, today we'll be going over order blocks, what they are, how to spot them and how to use them. So without further ado, let's get straight into it. What is an order block? An order block is a concept that highlights a change in the state of delivery. So it highlights the change from a buy model to a sell model or vice versa. So it could be from a sell model to a buy model. So this might not make sense now, but trust me, as soon as we get into the charts, it's going to make more and more sense. A bullish order block is, for example, the lowest candle with a down close that has the most range between open and close that is traded through by a later formed candle. So bullish order block, if I simplify that more, is the last down candle before an up move. If you look here, you'll see that we have what would be an example of a bullish order block. We have the last down close candle, which is then traded through by a bullish candle. So the red candle came down, then the bullish candle went up and closed above. As soon as the candle closes above and the market moves higher, then we have our order block. Three main ways of marking out an order block. You can mark it out from the wick to the next wick. That is the way most people mark it out. This is the way I mark it out. I mark it out from the open to the bottom wick. Another way is you could mark it out from the open to the close as well. So there's several ways of marking out an order block. It all depends on which one works best for you. I would personally recommend marking it out from the open to the bottom wick. If we take our Fibonacci and drag it from the top to the bottom of our order block, if we highlight the 50%, we will have what is called a mean threshold, which is the equilibrium of the order block. So the equilibrium of the order block is called the mean threshold. And vice versa, as you can see here, now we have a bearish order block. Same concept applies, just didn't change the colors, but a bullish candle closed here, going up, then the next candle closed going down. And that would have created our order block over here. And we have our mean threshold as well over here, which is the 50%. Now we have a high probability order block and a low probability order block. If you look at these two, you will notice that the high probability order block has more range within the candle. And the low probability order block has wicks which are larger than the candle's range. So when the wicks are larger than the candle's range, that is a weak order block, as the state in delivery wasn't changed as much. There wasn't a strong shift of momentum in that moment. Now, these are the confirmations for an order block that we want to see. When the market gives us an order block, we want the market to move up and take out the previous high. And when the market gives us the order block, preferably we would want it to take out liquidity, to take out a previous high or low. So think of it as support and resistance if you're a beginner. If this is support here, we want the market to break the support, then go up and break the resistance. That would be a strong order block. So if the market comes back to this area, we would look to buy because that is a valid, strong order block. If this was the scenario here, where the market didn't break the resistance, the market only went up and came back down, this wouldn't be a high probability order block, as the market did not break previous resistance. Let's go into the charts and look at a few examples of how it works. Okay, so here we have Euro USD on the daily time frame. The order flow, if you ask me right now, has just turned bearish. So we'll be looking for sells. So let's see what the market is doing. So if we can see, we're making lower lows and lower highs. So now we have a scenario where we made a high over here which swept this liquidity. So we mark out that sweep of liquidity. Then the market went down and took out this liquidity here at the bottom. So then we can mark out our order block. So remember I said it's the last up close candle before the down move. So right now we marked out our order block. We can also mark out our 50% of the order block if we want to enter off the 50%. A crucial thing to remember is that if you enter off the 50%, you're more likely to miss trades as the market will not always pull back to the 50%, but you will have a higher risk to reward. But if you enter at the open, you will get into more trades, but you will have a lower risk to reward. So you have to backtest and find out which one works best for you. So let's say in this scenario, we choose to enter off the 50%. Have our stop loss just behind, and we target this low here that was created. Okay, market went a little bit lower. Okay, so let's say that's our target over here. Okay, so we got tagged. The market came to our 50%. It actually went up to the extreme of the order block and reversed there. So now let's see what happens. The market pushed down lower. So now we look for another order block scenario. Okay, that is the order block. If you look here, we swept liquidity here and we took out liquidity here. So the last up candle before the down move is over here. So price never really moved away from the order block, but then this is also an order block. The reason I will not take this order block, we could enter a position right here with the stops behind. The reason I will not take this order block is because we do not have a displacement, which is a strong push after the order block. If you look here, we created the order block, then we had a strong push down, which gave us this displacement. So we don't have a displacement here. So I wouldn't take this position. As you can see, the market did go lower, but that would be an order block which isn't that high in terms of quality. So let's continue. Okay, if you look here, you'll realize that we created liquidity, we took out the liquidity, then went down and took out this low as well. So we can mark out our order block, the last up candle before the down. Same thing, we can choose to enter off the 50% or on the open of the order block. Let's say in this scenario, considering the fact that the risk to reward is good, let's say we enter off the open instead of the 50%. And we target the lows there. Let's say we enter here. You always want to put your stop loss 1 pip above the order block to give yourself room for spread and for the market to move. So something like that, 1 pip above the market. And let's play and see what happened. Okay, so would have been triggered in here by the open. Let's see. Oh, okay, so the market almost took us out here. So this is a reason why you want to give your order block room, as the market sometimes has a small wick above the order block. Let's continue and see what happens. And in this scenario, would have hit our target. So let's see what happens. Okay, we have another order block here. Okay, the market went down instead. Okay, seems like the market is coming back up here. So if you look here, you'll notice that we took out liquidity here as well. Then we went down and took out this liquidity. And we have our displacement here. So if we mark up the last up close candle before the down move, we can also include the wick of the next candle. That's the correct way to mark out our order block. So we could, let's say we enter off the bottom of that order block and have our stop loss just behind, like this. Target the low. Let's see if we do get an entry. Oof. Okay, so it seems like here would have been just tapped in. Let me see if I can drag this to the side. This was right here. So would have been tagged in to the tick. Let's continue. In this scenario, we came back and our target would have been hit over there. So I hope you're now understanding how we can use order blocks to find trades. So we just created another order block here. This is our order block. Let's see if the market comes back. In fact, this is the candle that went the highest. So this was supposed to be our order block here. But the market went lower. We have another one here. As you can see, we took out liquidity. Let's see what happens. We got tagged in. That would have been our entry right here at the bottom of, at the open of the order block, and our stop loss would have been just behind, with target being the low. Okay, so when that happens, that's when we have a change in the market direction, meaning that the market is now bullish, and we look for order blocks in the other direction. Okay, so if you look here, the market came down, it took out this liquidity here. We went higher and then took out this liquidity over here. So this would be our order block here, the last down close candle before the up move. So let's enter on the open of the order block. Stop loss just behind. Target, let's target a 1 to 2 in this scenario, just above the high. Or we could enter off the 50% instead. But let's just keep our entry here. Okay, target would have been hit in that scenario. Okay, we have another order block. We came, we took out liquidity. Last down close candle before the up move. Let's see if we get an entry. Seems like in this scenario, let's see. Okay, let me put this here. Okay, so we got triggered in there. So our stop loss would be just behind, and our target the top of the range. Let's see. Ooh, almost got stopped out. The market went up and hit our target. So that sums it up for how we use order blocks, what they are. Hope you enjoyed the video. If you did, please don't forget to subscribe, hit the bell notification, like a video, drop a comment on what you'd like to see next. And that's it for this video. Peace out.